So you're trading MEIC, iron condors, and you also trade DMA, take it.
So I don't trade MEIC or iron condors. So I trade this.
I
Yeah, I trade this strategy, which is the all-in at open. Then I trade the overnight balance strategy. I have some double calendars. Then I have indicators that are predominantly based on volatility getting smashed. When events don't happen, that's predominant trend following. And then most of my diversification through the mechanical stuff is basically through order diversification. So order and time. So if you're trading MEIC, you're exposed to any large move through basically the entire day of the market. Whereas if you update your stop or do something like that, you have more flexibility. Again, simplest principles possible. The more percentage of the of the premium we collect, we pay based on the bid ask, the less flexibility it gives us. So if you trade $1.50 each side, there's no potential for profit takes or management. It would just eat up all the premium capture. Whereas if you're trading closer to at the money structures that are managed like condors, you now have the ability to update stops, use trail stops, do profit takes, because the cost to get in and out is such a low percentage of the premium you collect, and you don't give up the PCR on that. So the mistake I see a lot of people make is they do MEIC, they like it, and then they'll try to add profit takes or early exits. And it's like you're trying to optimize the wrong strategy. Like the principle of harnessing the implied volatility, like that, it's not going to work when you're only collecting $1.50 and managing individual sides, because the premium and also MEIC, like MEIC is actually not that good at making money. It's just absolutely phenomenal at losing money, which in turn helps the compounding aspect of zero DT to do it.
Yeah.
So,
It has
yeah.
a low win rate compared to a lot of strategies. And when people try to take profits early, it just messes up the
Yeah.
expectancy.
And again, this is like when we actually think about it, it's like, what does MEIC do? It's like we're playing rebalance down here over a long period of time, and we're playing no volatility drag, and we're playing consistent return law of large numbers and compounding. So like that's the game you're playing. You're not playing optimizing a daily strategy. And like I give my buddies, like if you ever talk to me, I will just always say you're pissing away edge or you're curve fitting. So those should be the two questions you ask whenever you're doing anything. Am I pissing away edge? Am I curve fitting? And the more I do this, the simpler it gets, the less emotionally invested I get. And that's obviously a learned skill, but if it's complex and you can't explain it to me, like the concept could be advanced. Like I'm all for, concepts like this coin game and stuff. But the method of execution, I think it's a Steve Jobs thing. It's like the more complexity you institute, just the more things can go.
Would
Look-
you go back and re-explain that geometric compounding? I think I know what you're saying, but I'd like to say what it is.
Oh, here it is.
Yeah, you just passed it.
Okay, so if we, and this is slightly over dramatized for effect, but it's present. So right here we start with a $10 million account. So 25 basis points or 1/4% of this account is $2,500. So if we took $2,500 and added it to $10 million every single day for 500 days or 2 years of market days, we end up with 125%. However, if we took that initial $10 million value and just added 25 basis points or whatever the account value is every single day, you end up with a 251% return. And if you did that monthly, you get 245.